India overtook the UK in 2022 to become the fifth largest global economy when measured on the basis of gross domestic product or GDP. The International Monetary Fund, or the IMF, projects the country's prodigious rise in these rankings is likely to continue, and having been outside the top 10 just a decade ago, the country could feasibly leapfrog both Japan and Germany over the coming years, should India's forecast strong relative growth come to fruition. In today's episode, we'll discuss the current investment opportunity associated with this hugely important country, which cannot be ignored within global portfolios. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. Today we are joined by Kristy Fong, co-manager of the London-listed abrdn New India Investment Trust. Kristy joined abrdn in 2004 and is an investment manager on the Asian equities team. abrdn New India is a 350 million market cap investment trust which invests in a portfolio of businesses which are incorporated in, all which derive significant profits from India. Like many of the abrdn Asia and emerging market focused strategies, the philosophy is to seek out and invest in high quality companies within the region, meaning portfolio constituents tend to be lowly levered, well governed, and have durable and sustainable business models, an approach we would view as most appropriate for the core spine of most portfolios, but especially when looking at less mature emerging markets. India has risen the ranks to take the crown of the most populous country in the world. Projections of global population from the United Nations indicated that India's 1.4 billion population exceeded that of China last year. Crucially, India's population is also expected to continue to grow for several decades to come, and that's in sharp contrast to China, which reached a peak size recently and is now expected to enter a declining trend to match that of most developed economies. The demographic tailwinds behind India and several other Asian economies are well understood and documented within investment markets. However, in our view, a less well understood but similarly powerful trend underway is the growth in intra-regional trade between Asian economies themselves. The alliances within the region and the individual relationships with Western economies will always be complex and ever-changing. However, the Asian economic bloc is increasingly becoming a more independent and self-sustaining trade power. Intra-regional trade as a proportion of total trade has steadily increased since the 1990s, with imports and exports with the West now only accounting for circa 40% of the total on some estimates. This trend towards inter-regional trade is expected to continue, especially as economies of the larger Asian countries become driven more heavily by domestic consumption rather than exports. It could arguably accelerate should the reports of continued deglobalization post the global pandemic and also recent trade tensions be realised. India will clearly play a pivotal role in the development of the Asia region over the coming decades given its size, and an investment exposure to this specific structural trend can best be gained via domestically based businesses, hence our interest in abrdn New India in this episode, in addition to Vietnam Enterprise in episode 5 of our Investor Insights series. This was an interesting point in time to speak to Kristy, as a combination of several structural tailwinds have all coincided to fuel expectations for an inflection point in growth within India. The government has significantly stepped up infrastructure development in recent years, with a particular focus on roads, highways and railways, in order to place the country on a better footing to benefit from the clear trend of multinational corporations around the world diversifying supply chain strategies away from a reliance towards China. Stronger than expected domestic consumption growth within India has also led to forecast upgrades, and a fast adoption of digitalisation across the country over the last decade is now leading to the country accelerating the adoption of key goods and services. This improving outlook has not gone unnoticed by global investors, and interest in the Indian market has pushed domestic stocks to richer valuations over the last 12 months. We are watchful of current valuations in the short term. However, we do believe the Indian market rightly deserves to trade on a premium to many other neighbouring economies. The multi-party democracy with an independent central bank and an election commission and strong property rights under a common law system encourages an entrepreneurial domestic culture and a strong external investor interest, which consequently should provide the country with a sustainable long-term growth profile. Kristy, good morning. Thank you for joining us. How are you doing today?
Hi, good morning, Gordon. Very well, thank you.
Good stuff. So the first question we asked to kick these discussions off tries to get a bit of an insight into you and your kind of typical working week. I appreciate we're catching you whilst you're over visiting in London from Singapore. So I imagine your schedule's kind of packed with investor meetings, but is there perhaps a kind of anecdote from a recent company meeting or research trip or just an interesting article or book that you could share with us?
Yeah, I mean, yes, I am in London at the moment, and I'm seeing clients and also meeting the emerging markets team here. I always find it very interesting, actually, to see what clients are interested in and how my colleagues here are thinking about India relative to the emerging market investment universe. But before coming here, I guess that typical day would be trying to see companies, and I think in Singapore we have the luxury of having a lot of Indian corporates over. So there were two that I met recently that had a common theme of being, averagely run businesses, and now in the hands of new capable leadership that should lead to improving growth and returns. And this really just struck me how even though India today has such a favorable macro backdrop, it should not be difficult to do well. But the reality is that there can be competition, regulations, regulatory changes, inefficiencies, and so on. And honestly, management plays a big part. So even where, the market's expensive, everyone knows the great story, but there are still opportunities like that to see improving shareholder returns when you have a good set of management team who just do what's best for all shareholders. And there's still opportunities like that.
And so as you mentioned, we have had a pretty strong run from Indian equity markets over the last few years, really. And I mean, both in absolute terms, but also quite notably relative to other areas in Asia. And I guess a lot of that relative returns down to kind of weakness in China, kind of sentiment issues there, and also kind of economically. But could you kind of run us through what you see as driving the performance of the Indian market? And I guess the obvious next question is kind of how you're viewing valuations in the context of your kind of universe.
Yeah, I mean, you answered a bit of that. From a regional perspective in Asia, there are lots of positives going for India compared to, like you mentioned, China. So I think that makes India even more attractive and why we see this great interest here. And that's really driven by real fundamental improvements, not just at the macro level where you have stable currencies, ability to withstand high rates and high inflation, because India is not new to that. And we are seeing good corporate earnings growth, not across all segments, but across most segments. And I think the other factor has been the continuous rise in domestic flows that's been supportive of Indian equities, despite valuations. The way we're thinking about valuations, it is expensive relative to the region, relative to its historical averages. We see good reasons for that, but won't be surprised if there is a pullback or rotation to less expensive markets. Investors can be fickle that way. But we believe that India remains an attractive market, and for that, it will continue to command a valuation premium.
Perhaps let's go a bit into the portfolio itself. I mean, can you maybe talk us through some of the the kind of key investment themes that you see it over the kind of maybe medium term in the Indian market? And if you're able to kind of give us some examples of how you gain exposure to those themes, that would be great.
Okay. So yeah, we've always liked India for the domestic consumption story, and with a huge tech, software engineering and pharmaceutical talent pool, there is this outsourcing story we don't typically see elsewhere. In recent years, the investment themes have broadened to include digitalization, the ambition to decarbonize, and its infrastructure and manufacturing potential. So India today offers a huge range of listed opportunities to tap into these themes. In our portfolio, we have long-held companies like the private banks, Unilever India, that we see will remain as good domestic consumer or aspiration plays that will do well as long as the Indian economy continues on this journey of a multi-year economic upcycle. At the same time, we have seen reform in certain industries that have had their fair share of corruption and mismanagement in earlier years. And today, given the reform and the change, there are more companies that fit our quality profile. So this includes SBI Life and life insurance, which gives one the exposure to people in India wanting to do more of their savings, using insurance as a way to invest, or even their own health protection. Real estate also has gone through a decade-long downturn and finally recovering. But the more important theme here is that the regulations have led to consolidation towards the better-run, reputable developers, and also plays around the theme of urbanization in India. I can go on, but maybe just with the listings of tech IPOs, that's really given more of a platform for investing in these digital plays. So we have online platforms and digital advertising, an insurance aggregator, and the whole infrastructure takeoff is also opening up new ideas, not just an MNC like ABB, strong engineering firm, but also small family-owned companies are in our radar, like KEI Industries that makes cables. That's a more recent addition to the portfolio.
Thanks for that. And there's also been a pretty large amount of commentary on the diversification of supply chains, kind of that China plus one story. But I mean, you able to just share any kind of brief thoughts on how you think that plays out in India?
Yeah, I mean, it's there will be other countries in Asia that could benefit from this, but India also will be well placed for that, given how the Modi government has laid out a lot of incentives and making India a more attractive place to invest in compared to what it was in the past. Certainly, we are hearing of more companies and very high-profile big multinationals setting up factories, whether it's Apple or Samsung, the car makers, even Micron in semiconductors. But we're very clear about how it is China plus one. It will not replace China. We're very clear that it will take many years for Indian companies to go through the learning curve of getting production efficiencies up, training the domestic labor. So again, we see this more as a longer term story, but at the moment, good for India, good for job creation. And again, there are many different ways that we can consider getting exposure here. So it could be the likes of component suppliers. So again, we have another company that we recently introduced. Boring business, but less boring today because they are seeing more demand for their products like cables again, or lubricants, conductors.
My next question is that we speak to fund managers running kind of broad Asia managers mandates across Asia, and it is interesting you've been kind of speaking to the emerging markets guys at Aberdeen this week, but I mean, particularly those guys that implement what we would term a kind of quality investment style, such as that employed at Aberdeen. We often hear about them being kind of naturally drawn to India, having kind of an overweight exposure to India. And one of the reasons they typically give is that they're just a greater number of kind of well-managed, well-governed businesses that kind of get through their investment screens relative to other areas. I mean, would that be something that you'd agree with? And are you able to give us a sense of just the breadth of opportunity? I'm not saying that necessarily the governance is great across the piece, but just kind of how many opportunities there are that kind of get through your own process.
Yeah, I mean, absolutely. I'm going to reveal my age here, but that has always been the case since I joined Aberdeen in the 2000s. We've always liked India for the companies, and that remains even during difficult times when the country went through the global financial crisis or its various domestic crises. So we have always said that Indian companies we invest in did well despite of the macro and the government rather than because. And as I alluded to earlier, there's so much potential in India. So, but not always the easiest environment to operate in. And obviously, as a shareholder, there has been a fair share of scandals as well. So the key for us is to find good, trustworthy management teams. They can run businesses well, not make a mess of financial positions. We find that can often happen when the economy is doing well, companies get ahead of themselves, overstretch their balance sheet, and that often leads to a disaster. So there are a fair few of these companies in India, but thankfully, like you said, the Indian market has the depth and the breadth that we can find enough good companies, and which is why I had so much to share earlier in your previous question.
But when I guess the follow up to that is when we do look at the portfolio, there are, as you kind of alluded to, there are kind of notable emissions, some of those kind of large constituents, the Reliance Industries or the Adani Group, and that's had a kind of a swing on portfolio performance over time, because they're quite notable positions in the benchmark index. But are you able to maybe talk us through some of the red flags that you have when you're considering an investment?
Yeah, well, we do take a hard stance when a company fails our investment criteria, especially when it comes to corporate governance. I know today everyone talks about ESG, which is obviously a very key part of our investment process. That focus has always been on is on E, but for us, G has always been the starting point, because that is simply a reflection of the integrity of the key shareholders and the management team. And we find that normally for good G, there's a genuine effort to improve E and S. But I know I'm digressing here. So back to your question. We do our due diligence on the past track records of companies, the founders. We want to understand whether they're related party transactions, where the alignment is, how focused they are on the listed entity, whether there's enough oversight and checks and balances in the boards. And ultimately, the main thing for us is to understand how they grow, not just whether they are growing fast, but how they get there and whether they can do this in a sustainable way over cycles on their own and without any favors from others.
Maybe move on to the risks as you see it. Kind of what's keeping you up at night when you think about the portfolio. I know we're going into an election year. There's plenty of elections all around the world, but one also in India. I mean, can you maybe talk us through kind of the risks you see kind of leading up to that, or any other kind of major risks that you'd highlight?
Yeah, I mean, thankfully we do sleep quite well because we spend all our time on making sure that our companies are resilient despite market volatility. The key risk to my mind is still valuations and how high expectations are. Everyone obviously is very positive on India, and there's a lot of expectations around growth that's coming through more clearly in India as opposed to other markets. But I think with investors is always whether there's a surprise on that or whether there's a negative surprise. So I guess those are the things that we pay attention to, whether we have good earnings visibility, whether we have comfort around companies' financial prudence and risk management, because I think it's only when there is a unexpected event that some of these things show up in a bad way. So that's how we mitigate the concern that we have around valuations, constantly checking in with our companies, focusing on quality. Elections was something that was a little more, I wasn't highly concerned about that. It was always that low risk or tail risk that, we're not going to see that continuity that happens. But as always, one can never be complacent, especially with how hard the market has run. But overall, I won't say that we are afraid of share price corrections. In fact, we think it's always, a pullback's always a good chance for us to be building up positions in companies that we like, because we are still long-term shareholders.
And just to touch on the election again, I mean, is there potential for kind of policy changes? I mean, even if the BJP get in again, is there potential for policy changes as we approach the election, or as we go through it?
Yeah, hopefully not. I think that it was quite an encouraging sign that in the latest budget, the commitment was still clearly towards infrastructure, and there wasn't a lot of consumer subsidies and rollouts and things like that. So I think the priority is really clear, that country needs more infrastructure, needs to make sure that it is a good place for global companies to set up factories and facilities. So I don't really see a shift in that.
So Kristy, our final question is that we ask all of our kind of interviewees is to just highlight if there was just one particular area that you have a particularly high conviction in it at the moment within the portfolio. What would you say that was?
I guess the highest conviction still stands with sticking to quality companies. We've not always done better than the market. Certainly have been addressing that, but given how and we're very positive on India, but we cannot rule out any possibilities of a market correction because of valuations or shifts in interest to cheaper markets. So I think with that, it is all the more important to stick to companies that do what they say, that take advantage of the fundamental improvement in the economy. And again, prudent management teams that are just doing sensible things. So again, I think this is one philosophy that we are sticking to. Again, that focus on quality of businesses and management, and having that ESG being a very integral part of our philosophy.
Kristy, thank you so much for your time today. Always good to talk through things in India. But yeah, thank you for your time.
Thank you. Thanks, Gordon.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.